Good morning or afternoon, everybody, depending on where you're located, and welcome to today's webinar hosted by the Retirement Advantage and Kravitz Incorporated. Today we're going to be discussing the advantages of cash balance plans. My name is Bill Sunigal. I'm the Marketing and Communication Director for the Retirement Advantage. Today's panelists are Dan Kravitz, the President of Kravitz Inc., Janine Chung, the Director of Cash Balance Online, and Craig Mazzini, the National Sales Manager for the Retirement Advantage. Just to give you a little bit of background about our relationship, since 2009, Kravitz has been a tremendous business partner of the Retirement Advantage. Their efforts have helped us increase sales to build distribution of cash balance plans. Dan is a visionary in the retirement plan industry, and we are honored to be partnered with him and his team. Before we go any further, I just wanted to review the functionality of GoToWebinar. Your active participation is very important throughout the session. Right now, I have everyone on mute just to avoid any background noises that may distract you from listening to the webinar. You do, however, have the ability to submit questions using the chat pane or Q&A pane located in the right toolbar palette. There you can enter your questions and comments throughout the presentation, and your questions will be answered at the end of the webinar during the Q&A session. Without further ado, here's Dan Kravitz.
Hey, thank you, Bill. And good morning or good afternoon, everybody, depending where you are in the country. Anyway, the title of this presentation is Advantages of Cash Balance Plans. I'm Dan Kravitz, and I'm really happy that Kravitz and TRA have partnered together to put together this presentation. I'm going to talk for probably about 30 minutes, and then afterwards we'll take questions. During my 30-minute presentation, I'm hoping at the end of it you'll have a clear understanding of the cash balance marketplace, show you how to take advantage of the growth that we see in cash balance plans. And by the way, I'm going to go through some numbers with you based on our cash balance research report, and the growth has been tremendous. And then for those advisors that are looking to get into the cash balance marketplace or already in there and want to furtherly grow your business, I'm hoping to give you some tools. I'll give you 6 tips on strategies for how you can use your knowledge with cash balance plans to hopefully grow your business. So on our agenda today, the first thing I'm going to do is every year Kravitz, and we've been doing this for 10 years now, publishes a research report where we highlight all the trends and activities in cash balance plans. So I'm going to walk you through what we saw last year in terms of what happened in the cash balance marketplace. And then I'm going to try to help you understand, peel back the onion a little bit and talk about what's behind that record-setting growth. Size does matter. We'll spend a little bit of time talking about, there's really 2 different marketplaces in cash balance. There's large plans and what happens there, and then small plans. And the work that we do at TRA really is in the small and mid-sized market, and that's where all the activity is. You'll find 90% of all the activity is really in the small plan marketplace. Very different than what happens in the large plan marketplace. Give you some tips. I want to give you 6 tips on how you as a financial advisor can use the information you glean from this webinar or some other tools Kravitz and TRA will provide to you so you can hopefully grow your business. And last but not least, kind of what's new in the cash balance marketplace, and probably talk a little bit about volatility and investments. So I'm assuming that most of us that are attending this presentation are fully aware of cash balance plans. You have some basic knowledge. I would encourage you to talk to TRA or visit our website, cashbalancedesign.com. If you're really new and you want to learn about cash balance programs, I would encourage you to go to our frequently asked question or Cash Balance 101 space. But just as a friendly reminder, cash balance plans are hybrid plans. We like to say at Kravitz and TRA, they're the best of both worlds in that, like a 401k profit sharing plan, they're flexible, they're portable, and because everyone has an account, they're easy to understand. But in a cash balance plan, we're not subject to those pesky 401k limits. We have access to those high annual contribution limits based on age that a defined benefit plan affords us. So, we call them cash balance plans because Bank of America named their cash balance plan that way in 1984. Actually, if you read the regulations, they're called hybrid plans. Hybrid because they have characteristics of both defined contribution and defined benefit. And again, I'm not going to spend any more time during this webcast going through the basics. I'm assuming you already have that knowledge. And if you want to get further knowledge definitely encourage you to contact TRA or visit cashbalancedesign.com. So like I shared with you, for the last 9 years, Kravitz has been publishing a cash balance research report where we gather all the Form 5500s that were filed over, really collected them over the last 15 years. We go through that information, and then we report back to the marketplace what we see each year. And what we see is what I'm showing here. Look at this chart. Very exciting growth spurt from 2001 to today. We went from a little over 1,300 cash balance plans, now closing in on well over 15,000 cash balance plans. So it's the fastest growing sector of the retirement plan marketplace. In fact, when you compare that to 401k, year over year, cash balance plans have been growing 20% a year, while the 401k marketplace, which is a more saturated marketplace, a more mature marketplace is growing much slower, more at a 2% growth rate. So for those of you that are looking to grow your business, cash balance is a great place to be. There's no better place in terms of new plan formation than with cash balance plans. And what our report highlights, and by the way, you can download this report off that website, cashbalancedesign.com, but our most recent report highlighted the fact that cash balance assets now surpass $1 trillion. So for many years, we were always talking about a few $billion. A lot of advisors felt it was too small of a marketplace to focus on. But fast forward to today, now that there's well over $1 trillion, a lot of advisors and other retirement plan experts have decided to now focus on this particular marketplace. It's a great way to get assets under management. 19% growth rate, like I said earlier, versus 2%. This is where all the activity is in terms of new plan formation. In fact, cash balance plans now represent 30% of all defined benefit plans in our country. Compare that to back in 2001 when they represented a measly 3%. And where's this growth taking place? Well, 91% of all these plans are at companies with less than 100 employees. So these are primarily small businesses. I'll go over what type of businesses they are in a minute, but small, profitable professional service companies are driving this growth. And last but not least, another reason for this tremendous growth is in 2010 and again in 2014, we got some new regulations that made these plans easier to adopt, made them more flexible. And for those financial advisors on the phone, what will interest you is there's a lot more options today in terms of how you set up the investments and that interest crediting rate. So for all those reasons, we've seen a tremendous amount of growth in the cash balance space. And I really love this chart. As many of you know, the reason why, and I'll get into this in detail in a minute, why a lot of companies are adopting these plans, it's a tremendous way for you to help your client, the business owners, the executives, increase their retirement contributions, reduce their tax liability by making significant contributions to a cash balance plan. It's really the only plan left in the qualified plan space where you can kind of get around successfully the defined contribution limits and those 401k limits. But what I really love about these programs is that everyone benefits. Because of IRS testing and because of the rules, in order to have a cash balance plan and create those really large contributions for the owners and executives, we have to give a contribution to the employees. And what we find based on our research, when you look at all the 401k plans out there in the country, the average 401k plan sponsor spends about 3% of payroll on profit sharing and matching contributions. But compare that to a cash balance plan sponsor. On average, they spend 6.5% of pay on their employees. And so we find that by the financial advisors helping their clients establish a cash balance plan for the owners and executives, the employees benefit, and they see the employer contributions double, usually in the form of a profit-sharing contribution to pass testing to have the cash balance plan, but we see a doubling effect with the employees. So we see a huge increase in flow going into the 401k plan that you as the advisor might be managing. in addition to creating this brand new cash balance plan that creates these really large contributions for our business owners. You know, a lot of times when I get out there and do presentations with TRA, oftentimes we get asked by the business owner, wow, this is so great. It almost sounds like it's too good to be true. Is this legal? Well, the reason why this is legal, the reason why we're allowed to do this for our clients is because we are put in these additional contributions like we're showing here for the employees. You know, cash balance plans by asset size, you know, as you can see here, 34% of all cash balance plans, the 15,000 cash balance plans, that $1 trillion, are startup plans with less than $250,000. In fact, a lot of it, some advisors scratch their head and say, does it make sense for me to spend a lot of time and activity trying to land startup plans? Well, another, I don't have it up here on the screen, but another slide demonstrates that, you know, 90% of cash balance plans are tested together with a mature 401k profit sharing plan. So a lot of advisors don't mind spending some time in terms of establishing a startup plan because they know they're likely to win and get selected as the financial advisor on that 401k plan. It also, I think, protects you as the advisor by bringing innovative strategies like a cash balance plan to your client. You definitely want your competition to do it. But if that doesn't convince you, look at this chart and look at the $1 million to $10 million slot. 22% of all cash balance plans. So I would argue back when TRA and Kravitz worked with some advisors maybe 5 or 6 years ago, we were establishing a number of startup plans for our clients. Fast forward 5 or 6 years, a lot of those plans quickly have grown from $1 to $10 million, and they now represent 22% of all plans. And you can see in between that different asset sizes. So these plans grow quick. You know, for 2014, even though there was $1 trillion in those 15,000 plans, the annual flow into these cash balance plans is $25 billion. So because we're able to get around those 401k limits and we're allowed to put really large contributions in for our clients, these plans grow really fast. Okay. In terms of where in the country we're seeing this growth, this is kind of our top 10 chart. And California and New York, for the last 10 years that we've been producing our cash balance research report and reporting back to the marketplace what's happening, California and New York have always led the way in terms of the number of plans in this country. I think a lot of that has to do with the high state tax rate. I mean, I'm here in California, and between federal taxes and state taxes, you know, for every dollar you put into a cash balance plan, I tell clients here in this part of the country, you're probably going to save 55 cents per dollar in terms of tax liability reduction. But so New York and California continue to lead the way, but we also see other states like Florida and Texas had tremendous amount of growth. And remember, in Florida and Texas, there are no state taxes. You know, so other factors are you know, still you're saving the highest marginal tax rate is still close to 40%. So even with that additional state tax, we're seeing a tremendous activity in other parts of the country. In terms of why cash balance is so popular in certain states, well, for one, in addition to the state taxes that I alluded to, medical hubs. I'm going to show on a different slide, but the number one consumer of cash balance plans are medical groups. To get more specific, specialty medical groups, cardiologists, radiologists, anesthesiologists. They are the biggest consumer of these programs. Back in the 90s, when I started first marketing cash balance plans in a big way, we were focusing on law firms. Law firms were the number one consumer of these programs. Well, fast forward to 2016, it truly is medical groups. And where there's medical hubs in the country, where there's a concentration of medical groups, we're seeing a lot more cash balance plans go into play. Higher taxes. This is really the primary driver, in my opinion. In fact, years ago, when we first started doing cash balance plans, we thought it was all about retirement accumulation. A lot of our marketing materials talked about helping you save for retirement. When we hired a marketing firm to do some analysis, we were wrong about the number one driver. It wasn't retirement accumulation, it was tax reduction. People business owners, doctors, lawyers, they love that short-term benefit of cash balance that right away reduces their tax hit. They meet with their accountant at the end of the year. They find out that they have to pay a lot of money in taxes. They're not really focused on retirement accumulation, but they are focused on figuring out ways to reduce their tax check to Uncle Sam. And that's where a cash balance plan can come into play, and I'll talk about it in a little bit in terms of how it does that. But that's the number one driver. It's tax reduction first, retirement accumulation is definitely second. Population and age, remember we talked about Florida, for example, is seeing a large activity in cash balance plans. No doubt a lot of baby boomers, a lot of baby booming business owners looking for ways to increase their retirement accounts, still save on taxes there. And last but not least, you guys on the phone. What's really interesting is when Kravitz and TRA partner with a group of financial advisors in a certain part of the country, 3 to 5 years later, we suddenly see a number of cash balance plans taking hold in that city. So, if you decide that you want to make this part of your business and decide to focus on marketing cash balance plans, you could have an impact on where we see the growth. So back to this chart, which shows the growth rate. So what's driving all this growth? I mean, this is an incredible chart. This 20% annual growth rate year over year. Well, the number one thing that's driving the growth is taxes. And what we really saw was a lot of activity after 2012. Remember what happened in 2013 after 2012? Tax rates went up significantly on people earning more than $250,000. Just as a friendly reminder, if you make more than $250,000 a year, after 2012 and into 2013 and today, there was a new investment tax, a new payroll tax, cap gains and dividends tax went up. If you make more than $400,000, the highest marginal tax rate went from 35% to 40%. And I don't know if you realize this, but if you make more than $250,000 a year, those itemized tax deductions that you and your clients also enjoy start to phase out. And so what we found was after 2012, when these tax rates went up, people were looking for relief. And there's no better way to help your client reduce their tax hit than a tax deduction that is above the line, something that reduces your adjusted gross income. And that's what's so wonderful about cash balance plans. That's why we're seeing this tremendous growth, is a lot of people quickly acknowledge that a great way to shield yourself from the plethora of new taxes that went into effect after 2012 was by putting in a cash balance plan, which would reduce your adjusted gross income. Much better than other tax deductions, like making charitable contributions or paying mortgage interest on your primary residence. Those are below the line deductions, which have two big negatives. They phase out on high wage earners, and they don't reduce your adjusted gross income. In fact, we think this is such a powerful tool. We have a great handout. I'm sure we can make this available to everyone on the call after the presentation, or if you go to our website, cashbalancedesign.com, we have it there too, that tells the story of these new taxes that went into effect on high wage earners in 2013, and two real life examples of two clients that put in a cash balance plan and demonstrate how much money they save in taxes. I got to be honest, I go around the country and do presentations on cash balance plans, and nothing seems to get people more focused on it than when I can tell them objective dollar amounts in terms of how much money we can help them save in taxes. So in addition to taxes is definitely the number one driver. Second to that is no doubt people are looking to catch up on their retirement savings. We have a saying here at Kravitz that you can squeeze 20 years of savings into 10 with a cash balance plan. It's a great way for our clients to catch up. And this is a great chart that shows why cash balance plans play such an important role in helping business owners catch up on their retirement savings. I'm sure most of you are familiar with these limits, but the most you can put into a 401k profit sharing plan is roughly $50,000 a year. Depending on your age, you can put potentially another $250,000 into a qualified plan. So a business owner who might have been told by their current advisor that all they can save is $50,000 a year finds out from you that you can drive that up to $310,000 a year of annual contributions, maybe saving them $140,000 in taxes. Well, I got to tell you, that's a great story to tell for someone that is about to write a large check to Uncle Sam. And it's a great way to catch up on retirement savings. Another thing that's driving this growth, 10 years ago when I used to go around the country and talk about cash balance plans, I had this unique disadvantage that no one knew what I was talking about. I had to first spend a good part of the presentation just explaining what they are. Well, I'll share with you, if you decide to focus on cash balance plans and go tell this story, a lot of business owners now have heard of it. A lot of CPAs and tax advisors, they used to get embarrassed that they weren't familiar with cash balance plans are starting to become familiar with it. We've gone from 1,000 plans to 15,000 plans. There's been a lot more press, a lot more activity, and has resulted in a lot more awareness, which I think creates a better environment for you as advisors to go out and tell this story. The seeds have been planted, if you will. So I think it's a perfect storm for you to take advantage of cash balance plans. We got rising taxes. We have a retirement savings crisis. We got some legislative changes in 2006, 2010, and 2014. And last but not least, because of the hard work of a lot of people around the country, the public awareness is now up. And I think it's fertile ground for you as an advisor to partner with TRA and go out and market these plans to your clients. I alluded to earlier that size does matter. Back in the 90s, there was a lot of controversy around cash balance plans, and that really had to do with Fortune 500 companies setting these up as a way to get rid of their defined benefit plans. A lot of large companies, IBM being the most famous, use cash balance. They would convert their defined benefit plan into a cash balance plan as a way to slowly move away from defined benefit. And there were some legal challenges to the way those big companies did that. And for that reason, some of you on this webinar might remember those legal challenges went all the way to the U.S. Supreme Court. Well, in 2006, President Bush, before he left office, signed the Pension Protection Act, which cleared all those hurdles. And what was interesting is what happened by the time that was passed, all the big Fortune 500 companies had already exhausted, for the most part, cash balance. So no more activity there. But by clearing the hurdle, we suddenly saw a tremendous activity in the micro marketplace, in the small plan marketplace. And look at this chart. This really tells it. 91% of all cash balance plans are at companies with less than 100 employees. 57%, more than half of all cash balance plans, are at companies with less than 10 employees. So in terms of where you want to spend your time, you really want to spend your time with small employers. That's where all the activity is happening. That's where most of the plans are. That $1 trillion, if you want to have access to that $1 trillion of assets under management, most of that is happening in the small plan marketplace. So now what I would like to do is to hopefully give you some tips. I really like this part of the presentation. Here's 6 ideas in terms of how now you can go about and market your services to cash balance plans. Tip number 1, first make sure you choose the right market. This is not a mass market product like a 401k plan. This is really a niche product. It's only for a select group of your clients. So who is ideal? Well, business owners earning more than $250,000 with consistent profits. And in fact, and that's probably a little different number based on where you are in the country. If you're here in California with me, maybe it's business owners earning more than $400,000 a year. It's probably closer to that $250,000, maybe if you're in the South or the Midwest, where people have more disposable income. But you want to focus on business owners, really at the end of the year that have a common pain point. That pain point is that they ran a profitable business, and the reward for that is giving half their profit to Uncle Sam in taxes. I got to tell you, most business owners, most doctors, lawyers find that extremely annoying. And if you can come with an innovative strategy to reduce that tax liability, I think you'll be rewarded with some business with the cash balance plan, and maybe even take over the 401k plan. Who else is ideal? Baby boomers. A lot of baby boomers need to catch up on their retirement. A factoid that I share at some of the presentations I do with TRA with some of our joint clients is you need $1 million at age 65 to generate about $50,000 for the rest of your life. Do you as a business owner are you able to live on $50,000 a year? Are you on a path to have $1 million saved? Most business owners, the answer is no. So a cash balance plan can help them solve that and put them on a path to success in terms of the retirement savings. Who else is ideal? So in addition to focusing on, profitable business owners, focusing on baby boomers, new comparability plans. If you are an advisor to a 401k profit sharing plan where the client is maxing that out, they're putting in the $50,000 annual maximum into that program, you really need to contact TRA and present them a cash balance plan. I would argue that if you don't present cash balance to that client and he hears it from one of your competitors, there's a good chance you could lose them as a client. So we work with TRA to get those illustrations out. I would encourage you to make sure that all your new comparability plans, you're presenting cash balance plans. And if you're going to go market to businesses that have 401k profit sharing plans, find out if they're maxing out the owners. Do they use new comparability? If so, those are great candidates to present cash balance to. Who else is ideal? Well, if you look at the 15,000, 5,500s that are filed by these plans, and you look at the business code, a lot of these are professional service firms. Number one is medical groups, but we're also seeing accountants, law firms, people in the financial services industry. In fact, you on the phone, if a lot of advisors even put in cash balance plans. Here's a breakdown, though, of some of the top industries. If you look at offices of physicians, you add in the dentists, you add in the hospitals, almost 1/3 of cash balance plans are being sponsored in the medical sector. So, in terms of where you want to spend your time, you want to spend your time with medical groups, particularly specialty medical groups. Like I said earlier, when you peel back the onion on those groups, those are truly specialties, anesthesiologists, radiologists, cardiologists, and the like. But there are, some diverse businesses. We're here in California, so we have entertainment, some people in the entertainment field, in the music field. I think there's an online dating company that has a cash balance plan, some photographers, even some retail as well. So all sorts of different industries. It's definitely, the common factor is these are profitable businesses looking to shelter that profit from taxes. That seems to be the common factor in terms of these businesses. A third tip I want to give you is to reach out to the CPAs. I've done a lot of presentations with advisors and TRA where we present the cash balance to the business owner. Everyone's all excited about this new strategy. We hang up the phone and we find out that business owner calls his accountant or her accountant to get their opinion. And two things can happen there that can sabotage our efforts. One is the CPA is embarrassed that they didn't bring this innovative strategy to their client. So they tell some anecdotal story of a cash balance or defined benefit plan that went bad on one of their clients and tries to poo-poo the idea and encourage their client not to proceed. Or the CPA says, don't use that team of consultants. I have my own team of advisors and actuaries that can set up this cash balance plan, and he or she tries to convince the client to move forward with the cash balance plan, but with another team. In order to prevent that, what I would encourage you to do is find out who that CPA is, get him on your team. Maybe before you present it to the business owner, have a conversation with that CPA. Make sure that he doesn't get embarrassed by the presentation, that he didn't bring this innovative tax strategy. Not only will it help you win the client, but maybe that CPA could be a great referral source for you later. Who knows? Maybe you might even put a cash balance plan in for them as well. Tip number 4, sell the safe money strategy. I'm not going into the nuances of how the interest crediting rate works and how the investments work, but I think most of you know oftentimes the money in the cash balance plan is invested conservatively. And with the stock market being so volatile today, we find that a lot of clients and advisors are open to that conservative investment story. In fact, one thing we find, this is from our cash balance research report, is a lot of these cash balance plans, these 15,000 plans, are invested heavily in the equities market. If you look at the breakdown of the average cash balance plan, it's about 45% equities and 45% fixed income. We think, we were actually surprised when we saw that. We think a lot of advisors are not doing a good job by their clients in terms of helping them understand that a volatile market will have a severe impact on the cash balance plan. I think a lot of the advisors and clients have been riding the wave of what the stock markets have been doing, but when that turns, and we've seen that happen, we saw that happen in the dot-com crash, we saw that happen in the recession, and some people are fearful it could happen again. A lot of cash balance plan sponsors are going to be upset if their plans suddenly become underfunded. This might be a great opportunity, by the way, for you as advisors in terms of takeover plans, to help clients understand that maybe their asset allocation's out of whack and that they need to relook at that. In fact, my colleague Steve Sansone here wrote a really good article about this, and it's on our website, cashbalancedesign.com, and I'm sure we can get that out to you if you're interested. Contact your TRA salesman if that interests you. Number 6 is definitely partner with a CB specialist. Cash balance plans are highly technical. People that lack experience in this field can really cause malpractice. No doubt they're complex sales, and I think that's where TRA and Kravitz can be a great partner for you. We do hundreds and hundreds of these plans. A lot of TPAs might have 3 or 4 cash balance plans, maybe 20. We don't think that's enough. In fact, we have a great handout on our website to help you suss out whether or not maybe an alternative to TRA makes sense. If you're looking at another firm, I would definitely encourage you to ask them these 10 questions, and we can give you our answers. But we think that TRA and Kravitz bring a unique level of expertise to an advisor and a client that no one else has. We're the #1 provider of cash balance plans in the country, and these plans have a lot of landmines, and if you don't have that knowledge and expertise, it could go south really fast, and I think partnering with TRA makes a lot of sense. In terms of what's ahead, so some things to expect. We got some new regulations in 2014. Has a lot to do with those interest crediting rate options. The marketplace is still absorbing the impact of that. We've actually deployed a number of cash balance plans here using those new interest crediting rate options, and those are still being absorbed by the marketplace. Larger plans seem to be first adopters here with the new interest crediting rate options. By the way, if you don't know what I'm talking about with the new interest crediting rate options, definitely talk to TRA. We can get you some information about how the different ICRs work. But there's more awareness of those options, and people are becoming more and more experts on how these plans work, and we're seeing more sophisticated plans going into place. No doubt with the low interest rate environment we have, there's more now than ever a need for a good advisor to help a plan sponsor with these programs. We're in I'm sure everyone realizes we're in an election year. Usually in election years, we don't see any tax law changes, so we're not expecting any law changes to happen to impact cash balance plans. And last but not least, market volatility, we think, is driving cash balance popularity. When 401k plans and defined contributions plans see a lot of volatility in those accounts, we see a lot of people show more of an interest in reducing their tax liability, increasing their retirement accounts with cash balance plans that usually have more conservative investments. Well, anyway, I think I went a little over my 30 minutes. I think that took more like 40 minutes, but I hope you found this helpful. Some other resources that we have. The nice thing about partnering with TRA and Kravitz is we're, I believe, the only organization in the country that offers to the small plan and cash balance place daily valuation and participant technology tools that are akin to 401k tools. So that makes us really unique. We have an investment strategy that is designed for these plans. So if you're an asset gatherer and you're looking for help on how to manage the money, I'd love to talk to you about that. The Paid and Kravitz Fund's been around for the last, I believe, 8 or 9 years, and is designed for cash balance plans. Definitely, I've been talking about this website. We wrote a book called Beyond the 401k. You can go to Amazon. I believe the Kindle version is like $10. It's called Beyond the 401k, How Financial Advisors Can Grow Their Business. I would really encourage you to think about signing up for our Cash Balance Coach program. We're doing live sessions in October. Contact your TRA salesman. They have a discount code for that. I believe it cuts the cost of the program in half. I think it drops from $200 to about $100. So if you want that discount code and want to sign up for Cash Balance Coach, we go into it's a 4-hour web-based training program where we certify you to become a cash balance consultant. We Cash Balance 101, Cash Balance 201, Cash Balance Sales and Marketing, and Cash Balance Investments. So here's the contact information for TRA. What I'm going to do now is I'm going to hand it over to Bill, and then me and Janine will be available to answer questions.
Thank you, Dan. Looks like we have an abundance of questions in already, and I'll just jump right into it. Can a cash balance replace a 401k?
So a cash balance plan doesn't typically replace a 401k. It's usually added on because in order to pass testing, you need that 401k plan to supply the contributions to the rank and file employees to pass testing. So very rarely do I see a company only sponsor a cash balance plan. It's very rare. They typically add the cash balance plan as an additional vehicle to the 401k plan to provide benefits for the owners and employees.
Yeah, the handful I've seen is maybe one-man plan. You know, they just want to have one large deduction. That's the only time that could financially work because there's no testing requirement.
Thank you. Are CB plans IRSA and subject to new DOL?
Sure. So cash balance plan is a qualified plan subject to all the ERISA rules, therefore the non-discrimination testing rules and the combo testing that we've been talking about with Dan. Good news is that DOL rules are related to DC plans where the participants bear the investment cost, okay? And the investments are controlled by the participants, therefore the advice and all that fiduciary rules kick in. Cash balance plans are not subject to any of that because cash balance plan is a defined benefit plan where the assets are pooled and it's controlled by the trustees. We owe participants your contribution plus the ICR, the benefit calculated by the plan. The asset investments and the cost do not have any bearing to the participant's experience. So it's a lot easier in that sense to administer in relations to pooled assets and what that has to do because all the participants get are what's written in the document as your benefit plus the interest.
Thank you. Next question. As advisors, how do we take advantage of adding on a cash balance plan to a current 401k plan where the employer is happy with the existing relationship?
Yeah,
how do we position ourselves and how would we get that set up?
Yeah, so I would encourage, so I've run into this quite a bit where the client is happy with the current team on the 401k plan. I would encourage you to still try to get engaged on the cash balance plan. I see a lot of arrangements where there's one advisor handling the 401k, one advisor handling the cash balance. I think that gets you the foot in the door. And then, you know, typically what happens as these plans grow, they decide they want to consolidate with one advisor. And I think you got a really good, right? You got a 50-50 shot now of winning that 401k plan. So I kind of encourage advisors, don't get greedy. If you know, don't demand that you get hired for the 401k in order to be the advisor on the cash balance plan. Though that happens oftentimes, a lot of clients are unhappy with the team on the 401k, so often they're ready to hire TRA as the TPA, hire you as the advisor, and then also hire you for the cash balance plan. But I've been doing this a long time, and typically you bring an innovative strategy like this, an opportunity might not exist today, but it likely will exist tomorrow where we can take over that 401k plan.
Thank you, Dan. Next question. Can you elaborate on the cash balance certification program? Example of various levels of certifications, cost, and time involvement.
Yeah, so Kravitz has we put about 1,000 advisors, wholesalers, and TPAs through our Cash Balance Coach program. It's a 4-hour commitment. In October, we're running 4 live sessions. You can go to cashbalancedesign.com, click the coach section to see the dates of the live ones. If you can't make the 4 live webcasts, Cash Balance 101, 201, Sales and Marketing Investments, we record it, and then you can just watch it at your own convenience. Afterwards, we administer a test. If you pass the test, most of our advisors do. If you don't pass the first time, you can retake it. You get a certification from Kravitz. Some broker-dealers, it's called a CBC, Cash Balance Consultant. You have to check with your broker-dealer whether you can take the CBC and put it on your business card. I'll tell you anecdotally, I was working with, I believe, a Morgan Stanley advisor. He had to do a big cash balance presentation, I think, in a week. He quickly signed up for the course. The course, by the way, costs $200, but if you contact TRA and get the discount code, it's only $100 or $99. But anyway, he took the course, got the certification. We overnighted him the certificate. He did the presentation, showed them the certificate issued by Kravitz. I'm very proud of the fact that the client acknowledged that they knew Kravitz was, felt that Kravitz was a legitimate firm that added value to their advisors' education and knowledge, and he won that big case. And there's a lot of testimonials. To learn more about Cash Balance Coach, go to our website. You can learn a lot more. And the book too. You know, if you don't want to do the coach program, at a minimum, go to Amazon, buy the book for $10. It'll take you 2 hours to read it.
Thank you. Next question. How can we get the discount code for Cash Balance Coach?
Yeah, contact your TRA sales rep. If you look on your screen right now, you'll see the link to a list of the TRA sales reps, and there's a phone number that's on here as well. But just contact your TRA salesperson, let them know you're interested in signing up for Coach, and find out we have a special promo code just for TRA advisors.
Thank you. How do most advisors charge, and are there any fiduciary concerns if you are 338 on the 401k?
Yeah, you know what? So I'm going to encourage you to talk to my colleague Steve Sansone about what's going on in the Steve Sansone is my colleague here. He spends all his time and energy just talking to advisors about cash balance investments. He's very knowledgeable about the different fees. I mean, I'll share with you, it's just like 401k. It's not as competitive, but it's still competitive. So, some advisors are comfortable charging 1%. Others, might treat like a loss leader and charge 0.25%. But a lot of it depends on a lot of factors: the size of the plan, how many partners are in the program. I see 2 paths. Some advisors try to turn this into a profit center and might charge more like 1%. A lot of advisors will charge less because what they ultimately want are 2 things. They want relationships with all the partners of that big law firm or medical group. So they want the wealth management business there. They're going to go market their services that way, and they want to win that large 401k plan. So it's really up to your business strategy. I would encourage you to talk to your TRA sales rep, talk to Steve Sansone, who actually Steve and the TRA sales guys have a little more knowledge than I do in terms of what the marketplace is doing for advisors in terms of, and it differs based on geography, plan size, a lot of factors.
Thank you. Next question. What is ER contribution obligation to employees if they want to maximize their own plan?
Bill, can you repeat the question?
Yes. What is ER contribution obligation to employees if they want to maximize their own plan?
Yeah, typically it's going to be anywhere from the minimum is going to be 5% of pay employer contribution to the employees, all the way up to 7.5% of pay. That's typical. That's very likely you're going to have to contribute somewhere between 5 to 7.5% of payroll to the employees to pass testing. The only way to know for sure is get a census, give it to your TRA sales rep, and we'll produce an illustration.
And also, remember, we can do a carve-out design on cash balance, so please remember to walk away with the fact that we don't have to cover all of the employees. The larger the employer, as far as the number of employees are concerned, the more we can carve out. So when we talk about 5 to 7.5% possible profit sharing to your employees or the sponsor's employees, we mean only those that we have to cover in order to pass the test. So It's the selected group of employees that we have to give those what we call gateway 5 to 7.5%. That's why it makes a lot of sense if they're already doing that new comparability, as Dan talked about earlier. They may already be giving 3 or if not 5% already profit sharing. We can take that. That's a great starting point with potential additional contributions to selected group of employees if we do carve out design.
Thank you.
Janine,
Next question.
You read my mind on this. Oh, Bill, can I cut in there?
Sorry, Craig. Yeah, sorry, Craig.
That's right. So, yeah, typically, Janine, minimum is 40% of the employee base.
That's right.
And so you may be looking at as little as 40% of total employees. And like Janine said, if they're already on a safe harbor plan where they're maximizing profit sharing as well, you're really in a good position right there to not have it be a big expense or a liability on the employer to cover that in the cash balance. And I did want to take a quick second to go back to the question about what are advisors charging and, what are they investing in, how are they doing it? And Dan was right on, spot on, depending on the size of this and the whole relationship that you may have with that plan sponsor or key members of the company, it will range from, we've seen anywhere from 25 basis points to 1%. The 1% are becoming fewer and farther between. This is another opportunity to either use one of the investments that Kravitz has partnered with Payden to do that. You may also custody these assets at your broker-dealer. So if you're looking to increase your assets that are custodied at your broker-dealer, this is another way to do this within the plan and not having to deal with brokerage accounts for everybody because it is one pooled account.
Thanks, Craig. Next question. What reportable income constitutes as plan compensation?
Sure, that's a very good question. So when we talk about businesses, especially small businesses, they may feel like they have income of $1 million. We're not talking revenue here. We're talking what we call earned income. C corporations or S corp even, if you're incorporated owners, please ask them what their W-2 income is. Okay, you have to pay payroll taxes on your income for it to be counted towards the cash balance plan compensation for qualified plan testing purposes. So it's really the W-2 income of the owners. If they're a partnership, we're talking about earned income line from their K-1. Again, they have to be paying payroll taxes on the income for it to qualify as a compensation under the qualified plan. Similarly, if they are sole proprietors, we're talking about Schedule C income, final earned income line, not the initial number, what their revenue was, but what they take home as the earned income, payroll tax subject amount. So that's the compensation. W-2 is the key answer to corporations, K-1 or Schedule C, earned income for partners or sole proprietors. So that's really a key. Those advisors who have done businesses with us, you may bring in a client because they say, oh, I'm clearing $1 million this year. We really have to peel back the onion to pare down to the real compensation. And the good news is a lot of times going back to the employer contribution for the employees, we see an illustration that has 80, 90 cents on a dollar going to the owners. And that's our typical illustration for TRA clients and advisors that you guys bring in. So the proportion to what they take is a lot bigger than what they have to increase to staff in general, but it all comes back down to a very good question that Bill is posing about the compensation. They have to have either W-2 income or earned income. So when we talk about $265,000 IRS maximum this year, that needs to be on their W-2 or K-1. They can have less than that, right, depending on the age. If you're older, we may be able to give you a big contribution without the $265 as a compensation. But the bigger the compensation, the better. If you have employees, therefore, you are subject to non-discrimination testing.
Thank you. Next question. Who are ideal prospects for cash balance plans?
Yeah, so no doubt ideal prospects, any employer that has a 401k profit sharing plan already making a 3 or 5% of pay profit sharing to the employees and need a tax deduction or looking to reduce their taxes are ideal for this. You really need to contact TRA and get an illustration run for that client of yours. And like I said earlier, if you don't, my fearful place for you is someone else will, and you can lose that 401k plan as a client. And even if they don't do the cash balance plan this year, I can tell you from working with TRA over the years, oftentimes we end up doing the illustration again 2 years later, 3 years later, and they put the plan in place. I personally own a business. I got to tell you, to know that I have to give half my profit to Uncle Sam in taxes drives me insane. And if you can come up with a strategy to reduce that, and so that I don't mind giving a little more to my employees if it means that I don't have to pay as much money in taxes. It's the #1 pain point of business owners in the month of December. And so now's a great time to hit them with that.
Thanks, Dan. Another question. What are typical pitfalls in collecting payroll census for proposal illustration purposes?
Sure. The better census initially that we gather, the better outcome on the illustration, right? So just like any other proposals you might get, it will be garbage in, garbage out. What that means is get as much information about their current census as possible. When we say payroll information, we mean everybody. Whether there are family members working part-time on payroll, we need to know that. A lot of times, children of the owners who are in the payroll just doing 401ks could make a big impact on our testing result when we do the combo testing, trying to increase that older owner's benefit. We want to make sure that we know every part-time employees on that payroll, anybody who's come and gone, rehire, terminations. A little bit different than profit sharing in 401k and that cash balance. We have to make sure we account for everybody, even though we may do a carve out or we do combo testing, non-discrimination testing. We have to know everybody who's worked there during that year, prior year, and part-time, full-time basis. So get the census information as complete as possible would be our advice.
Thank you, Janine. Next question. How are the contribution formulas designed in the cash balance plan document?
Sure. So a lot of times what we write into the document is a flat dollar amount. It's a defined benefit plan, so therefore, we have to have a dollar amount that is within the individual's limit, but as Dan showed earlier, it's a lot bigger than the DC limit depending on your age and your compensation. So we typically pick a number that the participant, therefore usually an owner, would be comfortable with for next few years. We typically say about 3. And, whether that's 100,000, 250,000, depending on your age and what your limit might be, we pair that with a percentage of a compensation. So I'm getting a little technical and boring here, but we want to make sure that we have a cap on the compensation so that if the compensation or the earned income goes down in subsequent years, that contribution that we have chosen will be prorated down, so that we usually use a dollar amount. Those solo plans and other plans, we have put in formula into the document that says maximum available, what we call 415 limit. But typically we pick a number, and that's kind of a good point to remember when you set up a plan. This is not a discretionary defined contribution plan like the profit sharing. Pick the number you want from year to year. This is a commitment year after year that you have to pick going in. That's going to be written into a document, typically a 6-figure contribution commitment for the owners. So we want to make sure that they're comfortable with that year after year, but we do pair that with as a percent cap of their compensation to protect those years from when the income goes down, the contribution will be proportionately down.
Thank you, Janine. Next question. How often can a plan be amended?
Yeah, so there's kind of a myth out there that you can't, once you establish these plans, you cannot amend them and change the contribution. There is no law or rule that speaks to how often you can amend. With that said, we encourage our clients not to amend every year. We're concerned that if it was amended every year and you constantly change the contribution, the IRS might come back and argue this wasn't really a cash balance plan. This was really a 401k plan on steroids, a cash or deferred arrangement. So a good rule of thumb that we like to use is 3 years, that once you establish a cash balance plan, if you amend it, you then leave it alone for 3 years. It's not a law, it's just a guideline that we supply to our clients because we're fearful that if the IRS was to audit the plan and they see a lot of amendments, they could argue this was not really a pension plan, it was really a 401k plan, then it would be subject to those 401k limits. I got to be honest with you, I've been doing this a long time. I'm not aware of any clients that actually got in trouble for the frequency of amendments, but I think we as practitioners need to do a good job communicating that to our clients so that we don't start to see a lot of people amending every year and then the IRS might start cracking down.
Thank you, Dan. Next question. How does underfunded situation arise for a cash balance plan?
Well, remember, in a cash balance plan, we write a guaranteed interest crediting rate. Oftentimes, we like to use a fixed rate of 4%. When you go invest that money, if the investments don't achieve 4%, which is possible, it happens quite a bit, you're going to be underfunded. And the very simple solution is next year when we calculate the cash balance contribution, we increase it for that underfunding. Because a lot of these are startup plans, they're really small plans, we're typically talking very small numbers. So for example, if the contribution's $250,000 and it's short, 1 or 2 or 3%, or even the entire 4%, they're typically adding another $1,000 to the next year's contribution to make up that underfunding. And if that's too painful, we can amortize shortfalls over 7 years. So sometimes we're only talking like adding a few $100s to a $250,000 contribution. So it's when the plan becomes much more mature, that underfunding becomes more of an issue. And I got to share with you, we've seen a lot of our clients after 10 years start to deploy a really innovative strategy called strategic plan termination, where they terminate the cash balance plan, distribute all the assets, and then start a new cash balance plan as a way to get around that increasing underfunding issue.
Thanks, Dan. Another question. How is the October 1st deadline impacting me approaching a prospect for a new 401k plan now versus after October 1st?
For cash balance plan you're talking about?
Yes.
Yeah, so cash balance plan, we have until the year end, the December 31st, to adopt and make the plan effective.
Janine, hey, it's Craig. I think what the question might mean from the caller is that, hey, if these are so great to work in concert with the safe harbor plan, and you get a 10-1 deadline for setting up a new safe harbor plan for this year, what would you do or tell that plan sponsor if they wanted to start a cash balance and a 401k plan this year, and then maybe follow up with the answer you were heading down on an existing plan?
Right. So the cash balance, the safe harbor plan, if you want that to be in effect for 2016 and make that a safe harbor, it needs to be in place for 3 months. So we now need to adopt it for 2016 for the first year 401k plan to be safe harbor. So that's the deadline right now, and I know a lot of plans have been coming through. So if you want to see whether that particular DC 401k plan being implemented worth having a cash balance combo, we are running a lot of illustrations right now so that we can catch that October 1st.
Yeah, the beauty of cash balance is because most of the money for the owners is going into the cash balance plan, it might be acceptable in the first year not to be safe harbor and just make, there's a first you can have just do a 401k regular plan with a profit sharing component, and then add safe harbor later, maybe for the following year. We find sometimes, you might not even need the safe harbor and still have a great combo plan, 401k, profit sharing, and cash balance. Just the owners might do less 401k and do more profit sharing and more cash balance to get around the safe harbor rules.
But long story short, we have until the year end to decide that cash balance. So even if you're putting in the 401k right now, we have until December 31st for client to adopt. Therefore, we have December 1st early adoption cutoff for cash balance plan if you want to make that 2016 effective.
Thank you. Next question. When do PBGC premiums apply?
The PBGC, Pension Benefit Guaranty Corporation, is a unique IRS, government agency where it protects the defined benefit pension benefits, which means the cash balance plans may be subject to PBGC coverage. So when you have an illustration, if you're interested in finding out whether the plan may or may not be subject to PBGC coverage, we can determine that for you. A typical rule of thumb would be that if you're a professional corporation with less than 25 participants, you are exempt from the PBGC coverage, therefore no premium and no coverage. However, if you're a non-professional corporation, like we have a lot of entrepreneur businesses or restaurant businesses or entertainment businesses, regardless of the participant coverage, or professional corporations with more than 25 participants covered in the plan will be subject to PBGC annual premium because they have coverage by that agency to protect that defined benefit for the participants. It's an annual premium of, right now, I believe, $50, $60 per participant that you pay. And again, we can go over that case by case on an illustration when you bring that in, if that's subject. And we're very good at disclosing that requirement up front when we do the illustration proposal for you.
Thank you. And it looks like we have one more question. How does the combo testing, non-discrimination testing work?
So as Dan mentioned, it's a lot like new comparability. The bottom line I will tell you is that you have older owner and younger staff, that works out just fine. Not everybody in the census has to be younger versus the owner. But as long as you have generally an older employer and then younger employee, the testing will work out. We have many different ways to satisfy testing, but if they have makeup of employees that are different ages, we can make that testing work. But it works a lot like new comparability. Generally, if the owners are older and make more money than the staff, who are typically younger and less in compensation, testing will not be a problem.
Excellent. All right. Well, if there are no other questions, we're going to go ahead and wrap up with this webinar session. If you'd like to continue the conversation, as Dan had alluded, you can contact your TRA regional sales consultant directly at 888-872-2364, or you can contact them by visiting our website and identifying who your sales representative is based on proximity or geographic location. If you want to request a copy of this presentation or a link to view the webinar, you can contact me at Bill Sunigal at tra401k.com. That's spelled BILL .S as in Sam, UNAGEL at tra401k.com. Again, we appreciate your time and participation. Thank you very much and have a good rest of the day.
Thank you.